G'day guys, welcome back to the Devon Too Good Investing channel. Today we're going to be looking into Meta stock, or as some of you probably still call it, Facebook stock. And we're going to see if it's a good investment by doing an intrinsic valuation of Meta platforms. So one thing that I like to do, one exercise I like to run in my head is the difference between what we pay and what we get. So what we pay is obviously the market cap of the business, and then what we get is the underlying business and those three cash flows that the business generates over time. So let's get right into it. So first up, what are we paying? Well, we're paying $345 billion for the whole business. I like to think, when I value stocks, I like to think of it as though I'm buying the whole business and I'm a business owner, because at the end of the day, stocks are businesses. And I don't like to think of businesses as just pieces of paper that you can trade in and out. When I make an investment, I like to think about the long term and where the business's earnings, revenues, cash flows will be out 5-10 years in the future. So let's then have a look at what we're getting, because that's what's important. We want to make sure we're paying an appropriate price for what we're getting. So first of all, Facebook has a very strong balance sheet, and they have $48 billion in cash and cash equivalents. So some of it is held in cash, some of it is held in marketable securities, which they have invested, and the company has no debt. So if we take the market cap of $545 billion and minus that by the $48 billion on the balance sheet, that gives us an enterprise value, or an EV, of $497 billion. So the next number we want to consider is the cash flow from operations, and the cash flow from operations can be found on the cash flow statement. And for Facebook, on their cash flow statement, they have a cash flow from operations of $57.6 billion. And then if you go one line down on the cash flow statement, you'll see a CapEx value. Usually for Facebook's cash flow statement, they call it property, plant, and equipment. And this year, their CapEx for property, plant, and equipment was $18.5 billion. So what we want to do with these numbers is try to estimate what we call owner's earnings. So that's going to be cash flow from operations minus maintenance capital expenditure. Now, we don't know what this maintenance capital expenditure is. So because we're not told, we have to make an educated assumption based on our understanding of the business. So for this valuation, I think 50% of the CapEx is going to be used for maintenance, and then the other 50% is going to be used for growth. I feel like this is fairly conservative. So if we now use the owner's earnings formula, which is cash flow from operations minus maintenance CapEx, where we assume maintenance CapEx will be 50%. So we'll take that cash flow from operations of $57.6 billion and then minus that cash flow from operations by the maintenance CapEx, which is $18.5 billion times the 50% that we assume that is maintenance. And that ends up getting us an owner's earnings of $48.35 billion. So then based off that, we can get the enterprise value and then divide it by the owner's earnings to get a ratio. So if we divide those two numbers, that gives us a ratio of 10.28, which is almost a 10 cap on sort of an EV to owner's earnings basis, which is really historically cheap for Facebook. It's never been this cheap in its history in terms of this ratio here. And, for a company like this, based on its track record and, strong management team, strong networking effects, they got most of the Western world who have internet on using their platform at least monthly. Look, it seems like a real bargain right now. So if we now jump over to my margin of safety dashboard that I've developed, we can then see what we should be paying per share for Facebook. So first of all, I've entered in some growth rates. I believe it is very likely that Facebook will grow between 4 to 12% conservatively. If I had to put a number on it, I would be suggesting it's probably more likely that they grow between 8 to 12%. I feel like 6 and 4% is quite low, but just for the sake of this analysis, I've added that in there. But if we look one column over, I've entered in our owner's earnings that we calculated before in the previous slide. And then on top of that, I've added a terminal multiple of 15 because I think in 5 years, it's very likely that Facebook will be trading at roughly a 15. If we take into account, they might grow about 8%, which is around in line with the market. And the market usually trades in and around 15. Although you could also argue that this seems quite low. But then again, interest rates could easily affect this. There's a bunch of macro stuff that I don't really bother taking into account just because I feel like you can't predict that stuff anyway. But regardless, Facebook historically in terms of a terminal multiple or a PE ratio, they've traded at least 20. So they're trading at about 15 right now, which is a historic low. Sentiment is terrible for Facebook right now. And look, I think 15 is fairly conservative, and I think it's fairly representative at the same time. If we go down, have a look at the required rate of return now, I always have it at 22% because I'm targeting 15%, but if I aim for 22, that gives me a nice margin of safety there. And it pretty much gives me a 50% margin of safety because if you expand 15% growth per year out over 10 years, that's a 4x. But if you do 22% for 10 years, that's an 8x. So that's where I see that 50% margin of safety. I've added in the shares outstanding. I took that straight off the earnings report, and that's the number there. And then in terms of the net cash per share, I've pretty much taken the cash, the net cash, which we talked about in the previous slide, and divide it by the shares outstanding. So based off that, we're getting a buy price of between $167 and $223 right there. And at the moment, Facebook's trading at about a share price of about $200. So based off these factors, in order to make your 22% return, Facebook will have to grow at about 9% per year to achieve this over the next 5 years. So guys, I think Facebook is looking fairly juicy right now. Obviously, there's some risks associated, particularly around iOS changes, and if Google decides to do the same with Android, that's really going to affect Facebook's ability for targeting. However, at these prices, I feel like even if all that happens and Facebook's targeting isn't as effective, it's still a growing market. Digital advertising is not slowing down. Facebook is one of the leaders in that, and it's a lot more effective than traditional advertising, such as newspaper or TV ads and that sort of thing. Like, who even reads physical newspapers anyway? But I feel fairly comfortable with this valuation here, particularly at $194 or less. That's when I start to feel real comfortable because, I feel like, 8% growth rate, 6%, 4%, that's going to be really easy for Facebook to hit, especially, look, they've been growing 20% per year for a long, long time now. So, and then they're also going to be buying back shares along the way. So as the shares outstanding, count drops, it makes these values even easier to hit over time. But anyway, guys, I hope you enjoyed this video, and make sure you like and subscribe to my channel, and I'll see you in the next one. Bye.